It's time for Physician Family Finances, the show where physician moms and dads like you can get the answers and encouragement you need to turn a good earned income into great life outcomes for tomorrow and today.
Hello, physician moms and dads. I'm Nate Reineke, certified financial planner and primary advisor.
And I'm Chelsea Jones, also a certified financial planner and primary advisor here at Physician Family Financial Advisors.
Chelsea, it's almost Halloween. This will come out a couple days before. Is Anna old enough to trick or treat the old-fashioned way?
She is with like us going along with her. Yeah, she's we've gone to one trunk or treat so far because it's October, so there's going to be something going on the weekends. We've gone to one trunk or treat so far, and she gets kind of timid going up to ask for Halloween candy, but she'll be like, trick or treat, so quietly.
Yeah.
And that usually gives the person giving out candy a little chuckle, and they're like, "Aw, here you go."
Nice. Yeah, we've done trick or treating in our neighborhood for 5 years now, and we have some new parents like down the street, and they're like, "Will you show us the ropes?" Because there's some houses you got to avoid. And
Yeah.
this year, actually just yesterday, I went on a walk with Mateo. Miraculously, it's the middle of October, and it's just a nice sunny day. And we went on a walk, and he started counting all the houses with decorations because he thinks that's the only ones that give out candy. And so I think he counted 18. I was like,
That's still pretty good. Yeah.
Pretty good. All right, speaking of Halloween, there's some spooky stuff going on in the markets. So we're going to talk about that today, mixed in with some other great questions that aren't so spooky, but we're going to start with one. We got a question from a cardiologist in Oregon. We actually got two questions from them this week. The question is, should I own gold? You got this question, Chelsea, and you answered it, but I'm going to say my piece about this. That's okay.
Yep.
So I think it's important when you ask this question, especially to us. I mean, you have to understand our investment philosophy, right?
Yeah.
And the reason to buy gold or not buy gold or buy anything is not necessarily a prediction on whether or not gold will go up or gold will go down. The real reason to make an investment is to buy a productive asset, right? So when you buy a stock, you are buying into a business, and that business is theoretically productive. It goes out and it makes money. And gold is not a productive asset. Gold is simply a hedge against a variety of things, I guess, most of the time inflation. Right. And so it's not really a way, or you shouldn't be buying it, I would say, with the expectation that it's going to grow your portfolio, or it's just like a growth engine in your portfolio. It is a hedge. And in times like we're experiencing today, kind of inflationary times, there's some stress out there in the geopolitical world. It can be really tempting to buy it because it's a hedge against this chaotic world. But I believe that you should focus as an investor on long-term growth producing assets. And I'm going to ask you a question, Chelsea. What does Apple do when we experience inflation?
Probably raise their prices to account for it.
Right? They can set their own prices. So to say that you're buying gold as simply a hedge against inflation, that may be true. That you might be right. Inflation could go up and gold could go up. But the reality is that in long term, when you buy into businesses, they can raise their prices. Now, in short-term volatility, maybe they can't raise their prices immediately and people can't buy immediately. But a long-term view of this, if you zoom out and you stop thinking about this year or even the next 3 years, right? You are buying assets that protect you against inflation when you buy stocks. So I believe you should be buying into real companies, and the reality is that you will be protected against inflation if you continue to do that, and you're diversified in all sorts of companies that can set their own prices.
Mm-hmm.
So I'm curious what you thought, or if you agree with that, though.
Yeah, so there's a couple of things that I like to stress anytime we are talking about any kind of change in a portfolio.
Mm-hmm.
So this question was, there's no gold, should I buy gold?
Mm-hmm.
Um, the thing to remember is you don't want to be reactive when it comes to your investments. You don't want to hear something on the news, get afraid, and then pull money out of the market, for an example. You want to create an asset allocation in the beginning that aligns with your risk tolerance, something that you can stick to through the rough times in the market, um, without being fearful and pulling the money out. Because I've seen clients react that way and it's
Mm-hmm.
never worked out in their favor.
Yeah.
So, first thing to remember, kind of stick to your asset allocation. It's got to be a really, 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 really good reason to
Yeah.
change anything before you actually make a significant change.
Well, I can think of a good reason,
Mhm.
but it's a delicate one. The good
Yeah,
reason would be you can't stomach this,
yeah,
right?
that's
And so
yeah,
if someone's saying, should I sell out of my stocks? I'm not saying, I don't think strategically that's usually a good idea, but
right.
but psychologically, if you can't stomach being 90% stocks, 80% stocks, and you're asking that question, we need to have a heart to heart about whether or not you should
Yeah,
continue to be exposed this much to the stock
hmm,
market. And so,
yeah,
unfortunately, a lot of times that question comes up when the markets are down. By the
hmm.
way, they're not down; they're soaring.
There's
So
still
it's an interesting time.
yeah,
But yeah, okay. So yeah, it has to be a really, 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 really good reason.
yeah, and the yeah, and so one of the reasons would be, if you're fearful of the debasement of the U.S. dollar, which
Hmm.
if that happens, that's pretty significant. I don't know that holding gold would save us
Yeah.
if it actually happened to that extent. But the reason to buy gold is if that fear is so prevalent that the decision isn't truly, am I going to be investing in the stock market, or am I going to put money in gold, or is my money going to be in bonds, or is it going to be in gold?
Hmm.
Whenever that fear is so prevalent, the true decision is, am I going to take my money out and let it sit in cash,
Yeah.
or am I going to put it in gold?
Yeah.
And so if it comes down to that, we want to give
Sure.
advice that you're going to follow, that you
Hmm.
can stomach, and we want your money to work for you. And
Yeah.
so,
It is a bit unique to each person. I mean, I'm saying essentially for most people, probably shouldn't own gold. But if by by taking that advice, what you're saying, by taking that advice means you're just going to be in all cash, well,
mhm,
that's not good either. And it's not like gold doesn't get returns. It's just doesn't. It's not productive. So
mhm,
if owning to 5% of your portfolio in gold gets you back on the horse and
mhm,
allows you to invest your money appropriately, it's not going to make it so you can't retire,
right,
and it's not going to make you rich, right? But if it gives you some calmness amidst the
mhm,
chaos, um, it's not the end of the world either.
right,
So yeah, gold. And it's funny. Anytime the markets are moving like this, that's when you get the question. So I just want
mhm,
everyone to sit back and think about this. Um, were you asking yourself about gold before gold was soaring?
mhm,
And if you weren't, it's not to say that this is it's mainly to say, uh, you know, if you look back at history, that's the only reason it sounds smart or dumb. Nobody's going to know when gold's going to go up or down, and just like the stock market. So it's really easy to
mhm,
look at it and say it's going up, something really bad is happening or something really good is happening. But there's no way to tell. So what you could do is you can invest your money in kind of a tried and true way, which is to be really diversified and buy a whole bunch of companies, buy a whole bunch of bonds, and take a more smooth path to retirement and get the total market return, participate in the world's growth, buying international stocks, buying US stocks, buying bonds, and get a piece of everything, and the volatility will be less. It will be
Yeah.
it won't be as scary, but yeah, it's an interesting thought experiment. I don't get any questions about, you know, NFTs anymore
Right.
because they're just gone.
Yeah.
They're,
It's
you
not
know,
quick anymore.
okay, enough about gold. Cardiologist in Oregon again. My workplace plan now offers a Roth 403b. Should I maximize that to get more into my Roth, or just continue as normal with a backdoor Roth?
Mhm.
What do you think?
This was a great question. It's it's worth asking. But ultimately, so this cardiologist, up until he retires, is going to be making well into a six-figure salary.
Mm-hmm.
He's going to be in the highest federal marginal tax bracket. So it doesn't make sense to put money into the Roth when you're still in your highest earning years.
Yeah.
Um, and the benefit of the Roth gets less and less the closer you are to retirement. So,
Yes.
for example, if he defers his income, pre-tax this year and saves 47%. He's in Oregon. Oregon state tax is 10%, 37 federal. Say he saves 47% on every dollar he defers. But then next year, he's fully retired and he has the ability to take that money out. So it's in there a year or less, maybe a few months. And he pays taxes at the 24% rate,
Mm-hmm.
or maybe like a 27% effective rate, estimating. That's a 47 to 27, 20% permanent and virtually immediate tax savings.
That's right.
So, yeah, closer
Yeah,
you
and
are to retirement, the better the tax deferred option actually becomes.
yeah, it's always better, but the difference for high earning doctors, it's always better to defer the money.
Hmm.
But like you're saying, right on the cusp of retirement, it would be catastrophic to put it into the Roth. And I think there's one little piece that's missing here that's always interesting, at least for us, to think about. Um, the whole point of putting money in a Roth is so it grows tax free,
Hmm.
and how much growth are you going to get in 1 year?
Right.
Right? You'd have to get uh, the 20%. I mean, you'd have to get absurd growth. You'd have to
Yeah. Make up
it,
for the taxes that you just paid on it
yes, and it's more than
in your,
20%. I can't do the math in my head, but to
yeah.
take, it just wouldn't make any sense. Now, if you're really, really early on, I understand this question a little bit
Hmm.
more because there's this idea that maybe you'll get great returns over 30 years. But the reality is that for doctors in high income tax brackets, that you do the backdoor Roth because you have no other options. If you had more pre-tax options, you should take those.
Yes.
All right. A spouse of a dermatologist in Virginia. I want to retire at 50, but I know that we can't get Medicare until we're 65. What are our options to stop working or dramatically scale back with that in mind? I have an
Hmm.
answer. I'm sure you do
Yeah,
too.
I do. Yeah.
I'll let you go first.
Okay. Yeah. So this question came from one of my clients, and he brought it up because he recalled whenever we were doing planning, he was like, I remember you telling me that if we're retiring, quote unquote, early, meaning
Mm-hmm.
before 60, especially before 65, the cost of paying for private health care can be a bit of a burden. Like you
Mm-hmm.
have to save a lot to make up for that. Um, and so he wants to retire in his 50s. Um, Working at his current pace until 65 is just not a goal for them.
Mm-hmm.
So he was like, what can we do to kind of help offset the private healthcare costs before we reach Medicare without me having to work as much as I am now? And so The immediate options are you can always save more. That's always, whenever you're looking at the straight numbers, going to be one of the possible answers. But the approach that we actually are taking with his plan is just a dramatic scale back. So he's going to work enough to where his health care is covered under his employer.
Yeah.
Until they reach Medicare age. And then once they reach Medicare age, he's just going to stop working completely because the healthcare cost has gone down. So he's working significantly less or longer, which is sustainable because he's not going to be working at his current rate or his current pace. But he's offsetting that healthcare cost a bit, so they don't have to save as much as they would if they were just going to take on that full cost on their own.
Yeah. Huh. It's a better answer than I had. I said, save more money.
But you just got to have more money.
No, I like that though. Retiring at 50 is generally people just don't end up doing it. So saving every nickel until 50 and then being like, actually, I think I'm going to work a little longer. It sort of feels like a waste. So I like that. Most people get enjoyment out of working a couple days a week. So, and the benefits are,
that could be a game changer. Yeah.
It's huge. So, okay. Internal medicine doc in Washington. I just switched jobs, and my new employer, with my new employer, I can elect for a match to go into my 401k or take it as a cash balance. Which should I choose? I think they're talking about a cash balance plan.
Yeah.
Okay.
So whenever I looked at this client's benefits overview, they have a 401k that they contribute to no matter what they elect in this scenario, because this election is referring to the employer contribution. So the employer is saying, do you want us to put money into your 401k so that way it can invest and you take on the investment risk? Or do you want us to put the money that we would have contributed to the 401k into a cash balance plan instead, which is invested relatively conservatively, but it's a guaranteed benefit. It's a defined benefit plan. And this was a great question too, because usually the question is, should I participate in the 401k or should I participate in the cash balance plan? Where if they choose the cash balance plan, there's no 401k. It's an either or in most situations. But this one was really interesting because they have the 401k either way, but do they want this employer contribution to go 401k or cash balance? Ultimately, we went with the 401k because they still have quite a bit of time until they retire, and you have more flexibility with the 401k if you end up switching jobs.
Yeah.
So the intention is always the intention most of the time, unless you're super early on in your career, is, to stay at wherever you're working at forever. But life happens. A lot of times you end up switching jobs. The cash balance plan had a longer vesting period. I think you had to stay there for at least 5 years to be vested in the benefit. The 401k had a 3-year vesting period. Cash balance interest credit rate was, I believe, 5%. And they could get a higher
projected rate of return.
Projected rate of return in the 401k. Yeah.
Yeah. I actually thought you were going to go a different direction with this. It bleeds into my next question. Heavily. So what I thought you were going to say is just cash balance or 401k purely because of the projected rate of return or the expected rate of return, right? We know cash balance plans. It's just they're invested in less risk. They're taking less risk. It might be 50% stocks, 50% bonds. But I got a very similar. It's kind of what you were referring to. This is normally what happens. So I'll just let this run into that question. It was from a heme-onc in Iowa. I just changed jobs and am being asked to choose my retirement plan option, defined contribution plan or defined benefit plan. Which should I choose? I almost called these two questions. I almost did our own little segment called This or That.
Yeah.
Which is the same thing. But it is, it's open enrollment. And when you change jobs, a lot of times it's like when you start making these choices. So we're getting a lot of those questions. And you touched on a lot of this, but I'm just going to kind of answer it my own way. First, I want to we've done this many times, and I'm going to define contribution plan versus defined benefit plan. Defined contribution plan, this is your 401k or 403bs. Okay. But this is you and your employer put money in an account, a retirement account, and how much money you have at the end really is determined by how much you put in and how your investments do. I mean, you could put this in very, very low risk option, just like your a defined benefit plan, but you wouldn't, because you're probably in your 30s, 40s, even 50s. You have 10 years till retirement. You're going to take some risk, and you're expecting to get a better return in return for that risk that you're taking. Okay. Defined benefit plan is your employer is promising you, which is a little different than cash balance plan, but your employer is promising you a benefit. They're defining what your benefit is going to be. So this is essentially a pension, and it's just a calculation based on how long you've been there and what your salary was. Usually they do like your salary in the 3 years you made the most money, or your 5 years you made the most money. So there's all sorts of ways to analyze it, and they're all theoretical, right? Because we don't know what return you're going to get in your 401k. We don't know how your investments are going to do. We don't. It's hard to even project exactly what your pension will be, because a lot of times people get raises, and it's really difficult to know in the future. But you can get close with some of that analysis. And you just described it. It's like, do you want to take the risk? That is your risk in a 401k. Yeah. You are accepting that you're going to take the risk, versus do you want the risk to be put on your employer for theoretically a lower return? And then there's just the fact that with a pension, when you die, the pension dies with you. Yeah. So theoretically, if you can make more money in a 401k and you don't spend all of it, because you're not dying with zero here, then your children will get to inherit it. So that's the decision. And that's what most people are asking. But in this instance, and if this client is listening, they will fully agree with me. They change jobs about every 3 years, sometimes 3 months. And so the question on whether or not to take a pension is not hard.
Right.
They are not going to stay there 15 or 20 years.
Yeah.
They're just not. And if they do, it's not all bad, because usually your employer is trying to make the benefit roughly even. So in this case, their employer contribution is really high. It's really high. It's like one of the highest ones I've ever seen, other than if you're a partner and you're maxing out your 401k to $70,000 a year. So the question you have to ask yourself is this my forever job? Am I confident in that? Because if I'm not, I want this 401k to be portable. I want the money to come with me. And I don't want to take a severely reduced pension if I'm only going to be there a few years.
Right.
So I would say in most cases, unless it's like when you're making this decision, at least for our subset of clients, right, our subset of doctors that we talked to, a lot of times when they're faced with the choice, they do go with the 401k, but not always.
Right.
So individual to you. How'd I do?
Good.
We hit that from all angles.
We did. I feel like we kind of gave the same answer, though.
We did,
which
but
is
it was just the only difference
different
is
delivery.
Yeah, different delivery. There you go. Okay, that is it for today. Thank you, everybody, for listening. If you liked this episode, be sure to subscribe so you don't miss out when a new episode is released every Wednesday. And you can also leave us a rating wherever you are listening. And if you want to work with us, you can visit us at physicianfamily.com to schedule an interview. But if you're not ready for that, you can send us a question at podcast@physicianfamily.com. We'll answer your question even if it doesn't make it on the show. Until next time, remember, you're not just making a living, you're making a life.
Are you ready to turn worries about taxes and investing into all the money you need for college and retirement? It's time to make a plan and get on track. To find out if we're a match, visit physicianfamily.com and click Get Started. Or you can ask a question of your own by emailing podcast@physicianfamily.com. See marketing disclosures at physicianfamily.com/disclosures.